Today, we are talking China. China's economy has been slowing. It's no secret, although they're not exactly upfront with their economic data and really any of their information. I wanted to make this video about a month ago when we got that big stimulus package from the People's Bank of China in September, and we saw Chinese stocks soar. They had some of the best days that we've seen in quite a while. Unfortunately, I was in Europe, then I was moving, so this video got kind of postponed. China's economy is still struggling, and it looks like we could even see some more stimulus in the near future here. This is starting to become a big theme across the globe. We're seeing nations all over the world look to looser monetary policy and stimulus. And you know what that means? That means more inflation. That means asset prices are probably going to go higher. I'm not so sure about stocks, although we did see China's stocks perform very well after this stimulus announcement. I'm not exactly sure China is the best place to be investing right now, especially if we're going into a big global economic slowdown potentially, and this war that is going on in the Middle East could potentially propel that. Maybe we don't want to be betting on the world's factory if the world could potentially be shutting down for a period of time. But anyway, let's go ahead and take a look at some of the data here. China is experiencing weaker GDP growth than they've been accustomed to for the past couple of decades. And China really blew up over the past couple of decades. Not blew up, you know what I mean. Their economy really expanded as they became the world's factory. If we look at the first visual right here, we can see China's year-over-year GDP growth. As you can see, China's GDP growth was very impressive pretty much ever since we've entered the 21st century. Throughout the 2000s and the 2010s, we saw China's GDP grow a lot. During the GFC, we saw that China's GDP growth came down, and that makes sense as economies around the world were experiencing recession for a short period of time. But throughout the 2010s, China continued to see consistent GDP growth. Then we get hit with COVID in 2020, and this chart starts to look a little wonky. Their GDP growth goes down as the world economy kind of shuts down for a little under a year. Obviously, the year after the world economy shuts down, we're going to see the GDP growth year over year be very impressive that following year. But over the past couple of years, we've still seen consistent GDP growth in China, but we haven't seen it be as much as it was over the past couple of decades. It's not living up to their standards. And you also just keep in mind that when we're looking at GDP growth, we got to account for the inflation rate. If a country experiences 5% GDP growth, but their currency inflates 5%, did they really experience GDP growth in real terms? Not really. We need to think about things in real terms. Currencies, fiat currencies aren't the greatest measurement stick. We need to think about how much things are going up in relation to other things. Let's go ahead and take a look at a second visual here. China has been experiencing deflation. As we can see here, their producer price index has gone down year over year for the past couple of years. When we look at their CPI, it hasn't quite been in that deflation zone, but we've seen the CPI come down over the past couple of years. And I'm going to get into why we're seeing prices come down in China and why we're seeing less demand in general in a moment here. We could also look at house prices. Look at what has happened to house prices. House prices have come down over the past couple of years, and this is in big part due to China's real estate sector crisis. China's largest real estate developers like Evergrande, Country Garden, Kaisa Group, all these big developers have been significantly over indebted over the past decade or so. And when 2020 came around and the Chinese government put restrictions on the amount of debt these large developers could take on, it made it difficult for these large developers to refinance, in some cases impossible. So they weren't able to take out more money to pay off their previous debts And this led to these large real estate developers. The really pivotal one that kind of started this collapse was Evergrande. When they weren't able to make payments, we saw the real estate sector tank in China, and it has struggled to recover. This is a big reason why we saw China come in and introduce stimulus into the economy last month. Real estate is a very pivotal part of China's economy. It makes up 60 to 70% of household wealth, and it's about 30% of their economy when we look at their GDP. So the fact that real estate in China has really been struggling over the past couple of years, it's really putting a damper on consumer demand within China as households are looking to be more cautious with their money. They're not going out and spending as much, and that's leading to less demand within the country. It's also put a lot of pressure on local governments and other enterprises who have been heavily invested in real estate, who also took out a lot of debt to invest in the real estate sector. So they've seen their investment tank, and a lot of these other parties in China are also dealing with issues from being over indebted. So this real estate sector collapse is really taking its toll on China, but that's not the only reason that China is experiencing less demand. Another main reason why we're seeing China's economy slow is their demographic decline. China introduced this one-child policy to curb their overpopulation, but they kept it going for so long that now they're in a situation where their older population is growing and their working population is shrinking because all these people who have basically kept the world factory running that China is, they're getting too old to work, they're looking to retire, and now the younger generation, since they've had less kids, they can't maintain this world factory. They don't have enough human resources to keep being this manufacturing giant of the world. And also the younger generation is kind of burdened with taking care of this overpopulated older generation. So that's a major reason why we're seeing demand decline in China. And then the other big reason is trade tensions with the West and countries that they export to. We know that the United States and China entered a trade war in 2018 as the United States looked to become less reliant on China and also boost production within the country, right? Get rid of that trade deficit. Over the past couple of years, we've seen both the United States and China kind of hiding their tariffs, and we've seen this trade war escalate, and this is leading to less demand for Chinese exports as the United States is their number one customer. We know that the United States is a huge consumer economy, so this has really hurt China's economy over the past couple of years. We also think about Europe. Europe has looked to become less reliant on China as well. Europe is wary of tensions between the United States and China, and they know that if these tensions continue to heat up, continue to boil, they don't want to be over reliant on China as they are allied with the United States. Another reason that we're seeing less demand for Chinese exports in the West and also in other countries around the globe is that the whole world economy is currently slowing down. We know that here in the United States, we've seen a rise in layoffs, a rise in bankruptcies, a rise in unemployment. As more businesses look to cut costs and more businesses go under, that just leads to less demand from a key exporter like China. You could look at the same thing happening in Europe, and this is really happening around the globe. So if you're the world factory and you're seeing less customer demand from all these customers around the world, that's going to really impact your economy. This global slowdown isn't just hurting China as the world factory, but it's also hurting countries that import to China, right? Who provide these key inputs for the world factory. We could think about Australia, who is a major exporter of raw materials, things like iron. You can think about South Korea, some of those countries in Southeast Asia. You also look at South America, where a lot of these commodity exporters are, like Argentina, Brazil. When China's economy is slowing, we see all these exporters who are reliant upon China as their main customer, we see them take a hit as well. So really, with this global economic slowdown, we just see dominoes continue to run into each other, right? We're seeing less demand in the West, and then we see demand in China tank, and then all these countries who export to China also take a hit. So when the global economy is slowing down, it can really be kind of an exponential slowdown, and you throw in a big global conflict like we're seeing in the Middle East, and I'm not feeling super great about global demand over the next couple of years. Things are looking pretty shaky. Now, to save China's sinking economy, we saw the People's Bank of China unveil this large stimulus package in December, and that's what I mentioned at the beginning of the video. We saw the stock market shoot up very high. Let's go ahead and take a look at a visual of the Shanghai Composite Index, which is a good measurement of China's stock performance. As you can see, around the end of September, Chinese stocks went to the moon. You can see from the chart. This is a 6-month chart. It went up big. Now let's get into what the stimulus package entailed. We saw the PBOC reduce the reserve requirement ratio by 0.5 percentage points. And what the reserve requirement ratio is it's just the amount of cash or reserves that banks have to keep on hand that they can't loan out. So when a government reduces the reserve requirement ratio, it means that banks are able to loan more money out into the economy. We also saw the PBOC offer some support to the ailing real estate sector. They cut mortgage rates by 0.5 percentage points in order to incentivize more home buying. People have kind of shied away from the real estate sector as these large real estate developers have struggled, and we've seen real estate projects abandoned. So it looks like the Chinese government and the PBOC are really trying to stimulate this sector, right? They really need real estate to start thriving again. They also introduced a $42 billion loan initiative where they're offering loans to state-owned enterprises to buy up some of this residential real estate to stimulate the sector as well. We also saw the PBOC offer loans to companies for share buybacks and increasing their shares, which is a reason why we may have seen the stock market perform so well after the announcement of the stimulus. And it looks like more stimulus might be on the way soon. I was reading on ChinaBriefing.com that there are serious talks heating up about more fiscal stimulus, a potential $1 trillion stimulus package. And we know what that means. That means it's going to be bad for the money, the Chinese yuan, and it's probably going to be good for asset prices. And again, we're seeing this all over the globe. Governments around the globe are looking to looser monetary policy, and we know what that means, right? We know what that means for the money. It's going to inflate a lot more over the coming decade. So the major reason that China's stock market performed so well after this big stimulus package is just that stimulus leads to asset prices going up. And when you look at how the real estate sector has been performing over the past year, not well, it looks like there's just maybe a lack of avenues for Chinese investors. When we look at household wealth in China, 60 to 70% of it is held in real estate, while 20 to 30% of it is held in financial assets. You compare that to the United States. In the US, 25 to 30% of household wealth is held in real estate, and 65 to 70% of household wealth is held in financial assets. So maybe this is just a rebalancing that we're seeing in China as more people look away from the real estate sector and look to the stock market. But like I said, with the world economy slowing down and China being the world factory, I'm not necessarily sure that stocks in China are the best place to be right now. Now, when we look at the global impact of China's economic situation, it really affects everyone. China has ties with every country in one way or another, pretty much. We already talked about those countries who are reliant upon exporting to China, as China is one of their main customers, if not their main customer, like Australia, countries in South America, other countries in Asia. But we also got to think about countries who are reliant upon Chinese imports, like the United States, countries in Europe. How does this slowdown affect them? And if the stimulus works and we see China's economy start thriving again, what does that mean for these countries who are reliant upon imports? Now, as I've said, it looks like the whole global economy is kind of tanking. But as governments around the world look to looser monetary policy and stimulus, can this postpone a severe global recession, right? Can we see these economies recover in the short term? I'm not sure, and I'm not too optimistic about it. If we start seeing economies around the globe recover in the short term and we see global demand pick back up, especially in the West, in the United States, and Europe, that is definitely going to help China out. And that's probably going to lead to higher commodity prices as well. Now, if we don't see global demand pick back up, and I'm kind of in this camp just because I feel like we're kind of entering a period and moving into a new paradigm where economies are going to have to change and adjust to this internet era. We're going to see the structure of government change, in my opinion. I just feel like we are going to see some turmoil here over the next decade, as it just looks like we're entering a restructuring period. Governments can introduce stimulus and try to help their economies get by in the short term, but we know that stimulus doesn't actually help the economy. It just postpones the inevitable, that things are going to change. It leads to the same problems down the line at a higher price. So I think that we're probably going to see more issues in the global economy, and we're going to see countries go through a rough period over the next couple of years. You look at this growing conflict in the Middle East, we're reaching a boiling point there. There's a lot of tension between governments around the world. And then you also just look at the fact that most countries around the world are overly indebted. The debt issues that many countries are experiencing are really robbing their economies, as governments need to allocate more resources to paying off that debt, and they can't allocate that money to their own economy. And over time, this leads to more and more inflation, as governments need to create more liquidity to support their economy, right? Because they're having to pay all this money towards their debt. So they have to create more money to pay for other things, which leads to the money supply growing, which leads to inflation. And I think this trend is just going to continue. So whether we see governments introduce stimulus and economies around the globe recover or they don't, I think it's going to be very inflationary. We may see stock markets around the globe head higher with the money supply growing, but with all these signs that we're seeing, that economies like the United States and China are slowing, I feel like, why bet on stocks when you can just invest in a hard asset like Bitcoin or gold and get that benefit from that monetary debasement without the risk? So I definitely think we're going to see more inflation over the coming decade, and it'll be interesting to see what happens to the Chinese yuan if China introduces more and more stimulus. If we see countries outside of the United States continue to struggle and continue to shift to looser and looser monetary policy, and maybe we see the United States stay at somewhat of a tighter monetary policy, maybe we see the United States economy doing a little bit better, this could incentivize foreign investors to move to the dollar, to move to treasuries as a safe place to store their wealth. So that's just something to keep in mind too. I'm bearish on the dollar long term, but if we continue to see this global economic slowdown, a lot of people may still feel comfortable in the dollar, in treasuries, especially if we see this conflict continue to heat up. I bet a lot of people are willing to bet on the United States and the dollar. So it'll be interesting to see what happens with the dollar over the next couple of years. We know that liquidity is coming and we are going to see more inflation. So personally, I think it's a risky place to be, and I'm not there. I just have a couple dollars here and there to pay my monthly rent and to pay for my food. I think hard assets are the right spot to be, and Bitcoin is the hardest asset out there. That wraps it up for this video. If you didn't like and subscribe, please make sure to do that now. Thanks for watching. I'll be back soon.